This podcast is not legal advice and should not be relied upon as such. You should always obtain legal advice about your specific circumstances.
Welcome back, everyone. This is part 2 of our conversation with Michael Parker about M&A and the related tax issues. In part 2, picking up on where we left off, we're going to talk about purchase price structure, the allocation of purchase price consideration, and some issues arising post-completion. So let's say, Parker, we've got through the due diligence process and we're now at the point of nutting out a sale agreement. Now, any good sale agreement is going to have tax warranties and indemnities in it, and especially the case when it's shares that are changing hands. So in your view, what are the 2 or 3 sort of must-have, most important tax indemnities and warranties?
If I'm acting for a seller, I always want to see that there are some carve-outs in the warranties and indemnities that protect a taxpayer or protect a seller for things like liabilities that have been properly disclosed throughout the due diligence process or have been properly provisioned in the accounts that are provided to the purchaser. So in other words, the purchaser is aware of it, it's been provided for in the account, there's no surprises. I'd also like to see a carve out for any changes in legislation or judicial interpretation of the law to protect a seller against taxes that, in a sense, couldn't be foreseen because the law's changed. So that typically I want to see in there from a seller's point of view. If I'm acting for the purchaser, and particularly as you mentioned in the context of a share sale, I would want to see a specific warranty that the relevant target entity, be it a company or a trust, has not made a family trust election or an interposed entity election. Those elections have the effect practically that if the company or trust makes a distribution to people other than members of the relevant family group, that distribution will be subject to a special tax at the company or trust level, and effectively at 47% or full marginal rate plus Medicare. If we're selling a company or if we're buying a company, then typically speaking, the purchaser is not going to be a member of the family group. So the existence of that family trust election or interposed entity election really can make the deal fall over and mean that we need to go back to the drawing board in terms of how to structure the deal. And the final thing I always want to see, if I'm particularly acting for the purchaser in a share sale or unit sale, is that the company or trust provides a warranty that it's up to date with all its tax compliance, that it's not subject to any reviews by the ATO or other revenue authorities, and that it's not a party to any tax avoidance schemes or fraud or evasion.
Excellent. And the family trust interposed entity election issue is an especially scary one, and one that you want clients to be able to apprehend as early as possible because, as you say, it can be very complicated and even a deal breaker. So family trust elections is probably a topic for another podcast, I think, Parker. We might have to have you back next season to talk about those a little more because it can be scary stuff. So it's also the case, Michael, that the sale agreement will outline the purchase price structure. And from the perspective of the parties, the purchase price is one of the most important things. In our last podcast with James, we talked about earnouts, and I think we see those a lot, and we're seeing them more. And they're a common feature in a lot of deals, and I think they're perceived as a way of allowing a purchaser to hedge some of their risk in the deal by linking a portion or a percentage of the sale proceeds to future business performance. Now, earnouts have been a controversial and fraught topic for years and years in the tax world, and they can receive special, and one might even say slightly counterintuitive treatment for tax law purposes. So I know it's a very big topic, but could you briefly outline how this might work?
Sure, Frank. Well, traditionally, the ATO's long-standing view or approach to earnouts was to require the vendor, the seller, to work out what the market value of the earnout right was, and to include that market value as part of the proceeds for the sale. In other words, you worked out your sale proceeds as the cash that you'd received up front plus the market value of the earnout right, whatever that happened to be. Then if further funds were received under the earnout, that was seen as being a separate event, so a separate CGT event where you've partially disposed of your interest in the earnout right, and you might have a capital gain or even a capital loss as and when that earnout payment was received and there was this separate CGT event. Now, I think the ATO is right with that historical view. It made sense to me that you've received both cash proceeds and an asset, and you need to include the market value of the asset as part of your proceeds. It was seen, though, and you mentioned it was controversial, it was always seen as a bit controversial, not least because it required people to go out and try and obtain a market value for one of these earnout rights, which was practically difficult to do and costly to do as well. And so Treasury amended the law some years ago to bring in a specific regime dealing with earnouts for certain qualifying earnout arrangements, not all arrangements, but certain arrangements. And what those rules effectively do is ignore the earnout as being a separate asset. So you don't need to go and get necessarily a valuation of that asset and include that value in your capital proceeds. What you do instead is work out your capital gain based on the physical proceeds, the cash that you've received. And then in a later year, if you do happen to receive further proceeds as part of an earnout, you go back and amend your earlier year tax return to add in those additional proceeds as and when you receive them. And that might be over a number of years. So you might need to keep going back and amending your earlier year tax return to include those additional proceeds and increase your capital gain each time that happens. Now, those rules can be quite concessional in the sense, well, A, because it might mean you don't need to go and get a valuation of the earnout, right? So it's potentially saving you some cost in doing that, and also the risk that the ATO might not agree with that value. So it's saving you that exposure. But it also might mean that you get better CGT treatment of the earnout proceeds. So, for instance, if the earnout proceeds are received within 12 months of the initial sale, they can still be eligible for the 50% discount, provided that the relevant underlying asset was held for 12 months prior to sale. Whereas under the old earnout approach, if you've received and recognised the earnout as a separate asset and received a payment from that within 12 months of receiving that earnout right, it wouldn't be eligible for the 50% discount because you hadn't held the right for more than 12 months. So it can take that away, that issue away off the table. And it also might mean that if the original sale was eligible for the CGT small business concessions, then the additional proceeds that you receive under the earnout can get the same treatment that the original sale did. So they're also eligible for the CGT concessions if the original sale was. From that point of view, they're great. They won't, as I mentioned, apply to everyone. There are certain restrictions, not least of which is that they're not there to effectively allow you to defer the taxing point of proceeds artificially. And there's a 5-year cap on how long the earnout can be, and there are some other rules around them. But when they're available, these concessional rules, they're fantastic.
Brilliant. And of course, a classic tax issue we see in transactions, and especially where there's been a sale of shares is the allocation of the purchase price among those various shares. And there'll be a mix of shares. Some of them will be CGT assets, some of them won't. So, and oftentimes there may also be a tension between the parties about whose position is best maximised by the allocation of the purchase consideration. So, Michael, could you briefly outline this issue that we see a lot and that often arises, and again, just outline a little bit about how this issue might be managed?
Well, it is an issue that crops up a lot, and particularly where we're dealing with sellers who are either individuals or trusts who are eligible for the 50% CGT discount, or otherwise sellers who, whether they're individuals, trusts, companies, where they might be eligible for small business concessions, or even dealing with pre-CGT assets. And for those particular sellers, there would be generally a preference to try and have the proceeds allocated towards assets that are taxed under the CGT regime. Now, not all assets are taxed under the capital gains tax regime, but those that are things like goodwill, real property, trademarks, and there are others. But there are also assets that aren't taxed under the CGT regime, such as depreciable assets, and that can include copyright or interests in copyright, as well as trading stock. And for those other assets, such as depreciables or trading stock, because they're not taxed under the CGT regime, they're not eligible for any of the CGT concessions or the 50% discount. And if they're pre-CGT, they might not be eligible for concessional treatment under that regime either. So typically, as I say, a seller, where they're individuals or trusts or dealing with pre-CGT assets or eligible for small business concessions, would have a tendency to prefer proceeds allocated to capital gains tax assets or assets taxed under the CGT regime. By contrast, a buyer may prefer to allocate proceeds to trading stock or to those depreciable assets. And the reason being might be that they prefer to account for it that way. There might be commercial reasons and obviously tax reasons as well. But a lot of purchasers don't like acquiring goodwill or allocating proceeds to goodwill from an accounting and commercial point of view. So there can be a real tension between what the vendor or seller wants and what the purchaser wants. Now, typically what happens and what we recommend people do is to try and negotiate that allocation of proceeds and to agree it in writing, and ideally in the sale contract itself, which is then signed by the parties. And the ATO have traditionally said that if the allocation of proceeds is agreed in writing by the parties and has been the subject of a proper arm's length dealing, then they won't look to interfere with that. What's always important to bear in mind, though, is just because the parties themselves are arm's length parties, they're third parties, that doesn't mean that the transaction itself has been dealt with on an arm's length basis, or indeed the allocation or the decision how to allocate the proceeds has been dealt with on an arm's length basis. And the case law would suggest that if one of the parties is effectively agnostic about how the proceeds are allocated and they just don't turn their mind to it and allow the other party to determine how the proceeds are to be allocated, then that is not considered to be an arm's length dealing. And in a situation like that, the ATO would reserve the right to be able to come in and substitute what it considers to be the market value for the relevant assets, as opposed to what the parties have put in the contract. So something to just be aware of. And as I say, it's always, I think, best if you can demonstrate some evidence that there has been some toing and froing, some negotiating between the parties as to how the proceeds are to be allocated. And in a lot of dealings, we get involved in, there is some pretty strenuous negotiation going on about that because of the tension between what the vendor and what the purchaser wants. So if there's a exchange of emails or whatever it happens to be that evidences that, well and good. That stuff is important to keep on file.
And speaking of strenuous, Parker, you're doing all the talking here, so this has possibly been a strenuous exercise for you, but we are nearly at the end. And let's say that we have had a smooth deal, and the deal is completed, and the seller has the money in the bank, and we've all gone out for a big lavish lunch, and if you're there, we know we're going to get some fine wine and some very well selected vintages. But it feels like the end, and it is the end of the M&A process, but it's not necessarily the end of the story from a tax point of view. So, just briefly, what are a couple of the key tax considerations that have to be considered and have to be dealt with post completion?
Oh, thanks, Frank. It's a really important point. And I think what does occasionally happen, and hopefully happens very occasionally, is that the deal gets done, people just file it away in their bottom drawer and forget about it, and don't turn their mind to, hey, wait a minute, what things did we need to do post-transaction just to make sure that our house is in order? And it might be as simple as the seller working out what its tax position is, particularly whilst the transaction's fresh in everyone's mind, seeking advice where they need to seek advice in writing, and then preparing and lodging their tax returns accordingly. I mentioned there that it's best to do it while it's fresh in everyone's mind. That is so important. If people even leave it 6, 12 months down the track, human nature being what it is a real risk that people have lost sight of why certain things happened, or why the transaction was structured in a certain way. So it's best to do it sooner rather than later while it's fresh in everyone's mind. Another point is if the sellers look to apply the small business CGT concessions, then they need to make sure that they tick all the boxes with those. And that might mean things like making sure that there are CGT concession stakeholders or significant individuals in the relevant year of the CGT event. Once you've got a trust involved, and particularly a discretionary trust, determining whether you've got significant individuals and CGT concession stakeholders will often involve looking at who the trust makes distributions to. And we know that would often happen at 30 June or on or before 30 June. So there might be a bit of a lag between the transaction occurring and final distributions being made at the end of the year. So you want to make sure when those distributions are being made that people have still got their focus on making sure that things happen in the way they're meant to happen, to ensure that we do get significant individuals and concession stakeholders, and they don't lose track of or lose sight of that, and instead suddenly think, oh, we can distribute off to this beneficiary or that beneficiary who's on a relatively low tax rate, which might have the effect of meaning we don't access the concessions. And I've seen that happen, sadly, in real life, and it was a very unfortunate situation. Also, with those small business concessions, there are elections that sometimes need to be made in writing, choices in writing. It's a bit of an unusual thing these days in tax for you to have to actually make written elections. But for the small business concessions, there are some elections that must be made, and they need to be made by a certain point in time. Payments need to be made within a certain period of time, etc. So again, where those concessions are being applied is, again, keeping sight of that and diarising that certain things need to happen before the end of the year. Another final point I'd make is, and I mentioned earlier on, duties being an issue that it's often out of sight, I think, for practitioners. If there are dutiable transactions involved where there's been a sale, whether it's from a pre-sale restructure or from the purchaser's point of view, if they've acquired a piece of dutiable property or an interest in a trust or a company that's a landholder, for instance, then they need to be mindful of not only that there is potentially a duty of liability, but also the timing for making any applications to the relevant revenue officers and paying the duty in a timely fashion. Failure to do it can lead to penalties, and it's a thing again that just should be diarised at the end of the transaction and not just put in the bottom drawer, and 2 years down the track someone turns their mind to it and realises it's too late and there's huge penalties involved, or worse.
Excellent. Well, thank you so much, Michael, and an absolute delight having this conversation with you. And I think you've really showcased both your expertise and your experience in this podcast. So thank you so much. And thanks to everyone for listening today. And as always, if this podcast raises any questions for you, then please feel free to get in touch. All of our details are available on the Hall & Wilcox website, which is www.hallandwilcox, hallandwilcox.com.au, or connect with us or Hall & Wilcox on LinkedIn. And if you enjoyed today's episode, and I have no doubt that you would have, then please rate, review, or follow our podcast wherever you choose to get your podcast. Thank you very much.